Hi guys, and welcome back to Accounting 212. Our online semester continues here. Last week you guys had your very first exam for the semester. This week we can continue on our journey, and we actually go back to Chapter 3. So for our next section of this semester, we're going to be looking at Chapter 3, Chapter 4, Chapter 5. And we're really going to take a step and look back at a couple of the different ways that companies can go through and use accounting, and specifically managerial accounting, to concentrate on the costing of their business and the costing of their products and their services. It's so important. It's one of the main purposes of accounting, on top of the external reporting through financial statements and tax return preparation. One of the main primary purposes of accounting is to really understand not only the revenues of your business, but the costs of your business. Because if we think about in the business world, a lot of the times the way a company becomes more profitable is to get a better handle on their costs. They start off with growing their revenues, and then when they get to the point where their market is kind of set, there's other competitors, their customers are willing to pay X, Y, or Z for their product or service. Once that kind of works its way out, which generally your revenue or your sales are limited or are constrained by factors outside of your business, what you really need to focus on as a company to become more profitable is controlling and understanding your costs. The more a business can understand their costs, where the costs are being incurred, where it's using its resources, its employees, the better they understand that, the better decisions they can make, and generally the more profitable they can become just by understanding their costs. So today we're going to start talking about Chapter 3, and this week's we're focusing on Chapter 3. And the first thing we want to do is distinguish between job costing and process costing. So for the purposes of this chapter, we're going to be looking at job costing, but we just want to start off by kind of clarifying and distinguishing between the two types of costing. So first we start off with process costing, which is what we'll be focusing on in a couple of weeks down the road in Chapter 5. And process costing is going to be used by businesses that are really they're doing mass production of the same types of products. Basically what happens is they have a series of production steps or processes that every single one of their products that they're manufacturing is going to go through. It's the identical process. In our picture here in the slides, we can see a box of cereal, and if you think about that, Kellogg's or General Mills or all those cereal manufacturers, every single box of every single box of cereal that they're manufacturing is going to go through the same process, the same ingredients. Each box has the same amount of cereal in each one. So everything's exactly the same. So under process costing, and we're going to look at this obviously, like I said, in Chapter 5, but under process costing, the accounting is a little bit more straightforward, a little simpler. We're basically just going to add up all of our costs of manufacturing and then just divide by the number of units sold, because everyone's exactly the same. There's no point of trying to figure out what was in the first box of cereal versus the 5th versus the 75th versus the 144th. Every single box is exactly the same, so all we do is just take the average. If we spent $10,000 on manufacturing for the week and we made 1,000 products, well, we're just going to simply divide, and every product cost us $10, because there should be no distinguishing, and we should be able to tell the difference between the first product that went through our production line and the last product. So for process costing, it's going to be mass production of the same exact product. And when we go into this week, you'll see one of the items on top of your homework and your quiz will be a discussion board where we talk about a company, and you identify that as a process costing company, and then also a job costing company. So this slide's going to help you out there. And that brings us to our next item here, the next type of costing, that's job costing. And that's what we're going to be focusing on for this chapter. So with job costing, it's a unique custom ordered product is what we're talking about when it's job costing. It's going to be relatively small batches because each order, each customer need is going to be unique and separate. So each one of our batches or each one of our products, or this is also used a lot of time in the service industry. And I know some of you guys are accounting majors, some of you are finance majors. So, those two fields, each one of their customers, they get charged based on the amount of time and resources that goes into servicing that customer. So they each have their own specific job. Accounting in particular, I spent 9 years at an accounting firm, and one of the things when you get into public accounting is that you put in your time for every 15 minutes of your workday. And that way they know exactly on who you're working on, how much hours that the entire client or the entire job required. And that way they can bill out that client based off of the amount of resources, i.e. the accountant's time was spent on it. So a lot of service industries also spend job costing, where each one of their customers get a unique product or a unique service. Medical field does this. You can see in our examples here, Boeing, they're going to make custom-made airplanes for Southwest versus Delta, versus when Bob Kraft calls up and says we want 2 Patriot airliners, they're going to be custom-made. They're not exactly the same. So we use job costing because we start, all right, here's the new airplane for Bob Kraft. Here's the exact specifications. So we're going to keep track of all the materials, all the everything that goes into that, the amount of time, the development, all that stuff. That way that we can charge that client, Bob Kraft, for exactly what he got as that finished product, which is going to be different than if they were just making it for a different client or just a commercial airliner. So when we think of job costing, we're thinking of a unique product or unique service that we want to keep track of all the resources that went into it, so we can be able to bill that ultimate client based off of the resources that went into it. So we can have some examples here. So again, if you're watching this before you do kind of the rest of your assignments for the week, one of your assignments in the discussion board is going to be to come up with a company or a business or a product type that would be used in job costing and that would be used in process costing, and kind of distinguish between the two. So here's another good slide. If you keep track of your slides, this is in the regular PowerPoint as well. Most of these slides are. I generally just take things out. I don't usually add. That way you guys can go in and pull things out of the presentation just from the publisher. But here we have a good just breakdown, this slide, kind of what we just talked about in that last 2 slides, but just a overview of the difference between our job and our process costing systems and the types of companies and outputs, etc. So next we're going to go through, for learning objective 2, and understand the flow of production and how direct materials and direct labor are traced to jobs. And again, this chapter focusing on job costing. So from here on out, we're really just going to be talking about job costing. So here is our diagram of the flow of information, or the flow of inventory, through a manufacturing system. So it starts off as raw material inventory. So when we buy the product and the materials that are going to be used in our manufacturing process, when we first buy them from our vendors, generally a manufacturer is going to have a raw material storeroom or a warehouse, and that's where we keep all that stuff that we're going to be eventually using into our manufacturing, but before we do anything to it. So when we first buy it from our vendor, we're initially going to classify that as raw material. So it's the material we're going to use in our manufacturing, haven't done anything to it, so it's exactly the way we bought it, so it's raw material. Next, in our factory or in our production floor, once we actually physically start our manufacturing process, so we get the machines fired up, they're going to start going through. We have our workers going in and working on that manufacturing process. If we're making cars, or we're making toys or whatever, when we start adding that raw material to the production floor and we start turning into eventually our final products, in the accounting system, we're going to move it into this work in process inventory. And that's exactly what it sounds like based off of the name, work in process. So we're starting on a manufacturing process. It's in process of going from raw material to finished goods. And just like in real life, when we take it out of the storage closet or the storage room and we start working on it on the production floor, in our accounting system, we're going to move it from raw material. It's no longer raw material. We're starting to use it in the manufacturing process. So we're going to move it to work in process on our balance sheet. Once the manufacturing process is done and we have our finished products ready to be sold to our customers, we move it to that storing site on our physical location. We store the products off the manufacturing floor. We move it to our finished goods warehouse. And then in the accounting system, we also move it to finished goods inventory. And that way we can keep track of all the dollars, and in this case, all the job costs. Lastly, once it's actually sold to our customers, we finally move it to cost of goods sold, and that's where it becomes an expense. The first three items, raw material, work in process, and finished goods, those are all inventory accounts, so that's just moving the cost on our balance sheet, building up the cost of our inventory until it's finally sold to our customers, and that's when it finally goes to cost of goods sold, which is an expense item on our income statement. So that's where it actually finally goes into basically the profits and losses of the business. So first, when we start talking about our manufacturing process, if you're a business, you would sit down and come up with a production schedule. So this is the very beginning of our manufacturing process, or for the service industry or the medical industry, we also have a scheduling process. We figure out what clients are we going to serve. If you're in the medical, you're at a doctor's office, what patients are we going to see today? That's where you go in. And when you're at the doctor's, for the most part, unless it's an emergency or one of those where you just have to go to the hospital, but for the most part, you make a appointment to see the doctor, and that's what they're doing. They're figuring out the schedule. How much time do we have in our day? How many patients can we see? All right, let's schedule it out so that way we can maximize our limited resource, our time, to match up to our customer needs. So that's what we're doing in manufacturing. We're figuring out what needs to be made, when are we going to make it, and that way we can sell it to customers or get it into our warehouse so that it can be sold to customers later based off of anticipated demand. So we have two items that we'd worry about in our production process. So one would be custom orders, and that's again when a customer calls up and says, all right, we want this specific item made for us, and we want it in 2 weeks, 3 weeks, or as soon as possible. So those are generally going to kind of bump to the front of the line based off of our scheduling process, because if a customer is calling, we want to get that item turned around as soon as possible so we can secure that sale. The other item there is stock inventory. So companies will go in and they'll make a base model and they'll just have some of those in stock. That way, if a customer calls up and they just want the very basic model or the standard model, we have some of those in inventory already. We don't have to go through and make the process. We make the product every time. So most companies will have a base model. The other thing they can do is they'll make some base models that they can then later customize to specific needs. But we'll start off with that base. That way, when a customer calls up, they don't have to wait around all the time. Maybe we already have the base, or maybe we just have some final tweaking to do that. But that's what we want to figure out on our production schedule. What are we making and for what purpose? So on the production schedule, it indicates the quantity and the types of inventory scheduled to be manufactured during a specific period. And it's telling two things. First, we're figuring out what needs to be done and where. That's why we do any sort of scheduling. What's the priority, so to speak, and that way everyone's on the same page. But also it lets the production side of the business, they know if we're making 100 widgets, we need to have the raw materials for the 100 widgets. So once we have our production schedule, we look at what's available for inventory for raw materials, make sure we have that on hand. That way, if we're starting production on Monday, we have the material to start production. Also, it allows us to make sure we have the workers there, those direct labor people who are actually supposed to be making the product. If we have to make 100 widgets by Tuesday and we only have one person working, maybe we need to schedule some more people, or maybe we need to push back our schedule or anticipated completion time. So it gives you a couple different things. It lets you know what you should be working on, and then also it lets the people know, okay, we need this much raw material and we need this many people to be working. So here's our example, and we're going to use this kind of example throughout the chapter. So we have our production schedule for the month of December. So you would have, and every company might have a different way of showing this production schedule. A lot of companies, especially if you start talking about, the dental office or a doctor's office, they might just have a calendar with here's all the customers coming in, here's all the patients coming in, etc. But you're going to have a basic setup of your schedule. Here's the job. What are we making with the job if you're a manufacturer in particular? Or if you're a service industry, what are we doing for that client? So when I was at the public accounting firm, I would be in charge of scheduling for my clients. And I'd say, all right, here's the client, and then here's the service we're providing: audit, tax service, compilation, review service. So that way, and then we have the client. We generally would have a client number. And then you would have when does it need to get done by. That way we can, if it needs to be delivered by the end of the month, we need to start it 1 week, 2 weeks, 3 weeks, 4 weeks before that to make sure we have the timeline going. So in this case, we have, a couple different jobs going on here. We have the purpose of it. So some's for stock, just to have some of these on hand. Other ones, the bottom two there, we're going to have custom stock items made for the Chicago Bears. We know exactly how many we're going to make. We know when we're going to start each job and when they should be scheduled to be done. So we know what we're making, for who, how many, and then also when. So it's important to know all things. Now, when we starting these jobs, we can look at our raw material inventory and we can say, all right, do we have enough materials to do all these jobs in this given timeline? So our first item when we're talking about that manufacturing process is basically, do we have the raw materials? All right, so that's the first, when you're talking specifically about manufacturing, we need to have the components of our final product. In this case, this was job 603. We're making elliptical cross trainers. So in order to make a cross trainer, we'd have to have all the parts that go into that. So our first thing that a manufacturer would have is they would have all of their products, and in their system or in their database or in their software, they'd have a basically their bill of materials. So for every one of their products they make, they would have all the individual components that go into that product. So generally it would start with the high-end items. So if you think about a machine at the gym, an elliptical machine at the gym, they have a heart rate monitor, they have the TV screens, they have the roller bases, they have hand grips, they have the foot platforms. So they'd have all these items on there, the main components that go into it. And you would have exactly, to make one of these, you need these 37 parts, even down to the minute details of screws and lubricants and all the things that go into that. You would make sure you have all those things. So that way when you start the job, all right, next week we're going to be working on elliptical machines, you could pull up that bill of material and you would ask the inventory manager of raw materials or the inventory department, do we have all of these products based off of the bill of materials? So if each elliptical cross trainer has one heart monitor and we're making 50, obviously you would extrapolate that, so you need 50 heart rate monitors. We need 50 LCD entertainment screens. We need 100 roller bases. So you'd have this bill of material, and once we know we're going to be making that, you would check to make sure we have that. Now you'd go, basically, each one of our raw material items, each one of our components, we would have an inventory listing of that. So we have here our example of our heart rate monitors. And, for the most part, they might look a little different when you get into the real world. Every software, every business might have a different way of doing this. Larger businesses, obviously, it's going to be all automated, all computerized. Some might just have a piece of paper with a sign-out sheet, sign-in sheet for inventory. But basically, we're going to have a running total of how much of each one of our products do we have. So here we have on 11/25, we received 100 of these heart rate monitors. So we can see on the right-hand column the running balance. So we have 100 of the units at $60 each, so that cost us $6,000. On 11/30, so 5 days later, we had a job that used up 70 of those. So now on the right-hand column of the balance, we only have 30. So what's going to happen is if we're scheduled to make 50, our inventory system, once we put it in there or once we start the process, depending on how a company maintains their inventory, they would look at, all right, we need raw materials, we need 50 heart rate monitors. They could go to their raw materials record and they would see, all right, we only have 30 though. So that means what? That means we have to go order some more. So that scheduling process isn't so important, and we want to make sure we can schedule it out well before time. That way we know if we're going to make 50 of these, we have enough lead time to go ahead and order enough of those components. So this is just one of those examples. Our heart rate monitors, the purchasing manager or the production manager would go through. All right, we're going to make 50 next week. We only have 30 as of 11/30, so let's order some more. So when we're talking about the purchasing of raw materials, basically we have three documents that we want to make sure all match up. That way we know we're getting exactly what we want and what we need, and we're paying for exactly what we received and what we wanted. Our first item there is our purchase order, and basically that's just when a company goes through and they say this is what we're going to buy, and we're going to buy it from this vendor, and here's how much it's going to cost us. Next, we have our receiving report, and that's basically when a business receives their raw material or receives their delivery from their vendor. It's going to have exactly what was included in that delivery, whether it's delivered by the vendor or from UPS. There's going to be a piece of paper in there that says here's exactly how much was shipped, and then what you would do on the company side when you receive that product. We're going to make sure if we ordered 100, that's how much received, and that's how much physically is in the pallet or in the delivery, and that's how much is on the receiving report as well. So we want to make sure that what we order is what we receive. And then lastly, what we order, what we received, is what we are billed for. So that's our invoice. So in the world of business, you want to make sure you want to reconcile all of those items. Because you don't want to, if you only need 100, you don't want to receive 200, because you might not need it right now, or it might go bad, or it might change in technology. If it's a custom order, maybe you don't need more than that. You only need exactly what's for that custom order. So if we order 100, we want to make sure we receive 100, and that's what the paperwork says, and that's physically how many we receive. So we want to count the delivery. And then most importantly there, we want to make sure that's all we're billed for, is what we actually received, which is exactly what we ordered. So we don't want to pay for more than what we ordered. We don't want to pay for more than what we received. If we ordered 100, that's how many we want to receive. That's how many we want to pay for. So we have those three items that kind of go hand in hand when we're talking about purchasing of raw material. And for some of you, if you're already in a business, if you're working, and this could be whether it's a full-time job or maybe a part-time job, if you're working at a retailer or a company, maybe you were in the receiving department and you probably were doing some of these steps in the process, and you were doing some internal controls related to our inventory. And I just want to go back here for a slide, so back to the purchasing of raw material. This raw material record, if we think about it, it'd be similar to if you're going to a retailer. If you go to Target, when you go to check out, the purchase and sales system is automatically talking to their inventory system. And when they get a delivery from their vendor, that would be their received column. And then for a retailer, their used column would really be their purchased column. So if they received 100 from their vendor, and then customers came in basically and used or purchased their 70 units, and that would be their balance. And then managers at a retailer would go through, and if it's a delivery on a Monday or a Tuesday, sometime before that, they would say, all right, here's our balance. Let's get back up to that ideal balance. So we need to order 70 more or 100 more. But it's the same way if we think about it internally for a manufacturer. They're buying product from their vendors, and then they're basically the manufacturing department, the workers that are actually making their final product, they're buying it from their raw material warehouse. So it's the same as when you go to a retailer and they have bought things from their vendors, so they have it on the shelf, and then instead of using it, they're selling it to our customers, and then they have to reorder to replenish. That way the next customers that come in can go ahead and buy it. That's what's happening, and the way it's working at like a Target or a Walmart or Stop and Shop or Shaw's or whatever. When you're going in, their systems are all interconnected, so they're receiving it, it gets added to their system, and then when their customers, every individual customer is ringing up, it's automatically being deducted from their invoice, from their inventory system. So next now that we have how we get our raw materials, basically how we get added to our raw material inventory account, so how that builds up that we're going to be using for our manufacturing. Next we move into our job cost record. And our job cost record is basically, it tracks all of our direct materials, direct labor, and manufacturing overhead that's used on these individual jobs. Now, if you remember back, our job costing is going to be used by a company that is providing a unique product or a unique service. So it's important that each one of these products or each one of these jobs, each one of these customers have their own job cost sheet, because each one's going to be a little bit different. And so we want to track how much resources goes into providing services or products to that client. At the same time, we want to be able to bill the customer for exactly the amount of resources they are being used. And think about it this way, if because we're making unique products and each one's a little bit differently, or each service is a little differently, from a customer standpoint, if you're only going in for a routine physical at the doctor's office, if they're not using job costing and they're just going to charge you a flat fee based off of everybody, what they're paying, you're not going to be too happy if you just went in for a routine checkup appointment or routine physical, whereas other people went in for x-rays and MRIs and shots and vaccines and medicine. You're not going to be happy if you guys paid the exact amount or the exact same amount. You want to be charged as the customer for exactly how much benefit, how much of those resources that that service industry or that manufacturer provides, how much you're actually getting. So it kind of works both ways here. The customer pays for what they're using, and the business can keep track of what each one of those customers are using so they can see how profitable they are and to generate those invoices. So in this, with our job costing records, each one of our customers or each one of our jobs is going to have one. And if we have the same customer having multiple jobs, they could each have multiple job records. That way we can say, for this job, we're using this amount of resource, this job, we're using this amount of resources. That way we can send them two individual invoices, two individual bills for what they're actually providing under each one of those jobs. So with a job cost record, and here's our example here, it's going to show all the materials, all the labor, and all the overhead used. It's going to show the total job cost. So when we talk about if a problem on the homework or whatever asks you for your total job cost, you just want to make sure you add up all these three items to get that total. And on our job cost record, we're going to have the number of units that are produced, and then also by dividing that total job cost once we're done by that units, we can get an average cost per unit within this job. So we see here in our example, we're still going through that elliptical cross trainer. So it's job 603. The customer was 4 stock, so we're just building up our stock. We have our job description, so 50 units of X4 elliptical cross trainers, and we'd have the date started, and then once it's done, the date completed. So once our job gets started, so we're getting into work on Monday, December 2nd, we're starting up this job, we're now going to be building up all these costs, building up our materials that we're using, building up our labor costs based on who's actually working on it, building up our overhead based off our overhead rates, which we're going to talk about in a minute. And then that way we can build up those costs for this job, and then it's going to go all into work in process. And then once the job is done, on our job cost record, we fill in our date completed, and that's when it would move over to that finished goods. If you remember back to that diagram of the flow of costs through our inventory system, this job cost record tells us when does it go into work in process, and then when would it go into finished goods. So the first thing we do is going to be adding direct materials to our jobs. So we do that physically by going into the warehouse or the storage room and grabbing our raw materials that we need, because that's going to again be that first step of the manufacturing process. We need the raw material that we're going to be turning in to our finished goods for our inventory, the final product that we're selling to our customer. So when we physically grab that, in our accounting system, we're going to provide a materials requisition. So this is basically like our shopping list. So we're making 50 elliptical machines. It's job 603. So we'd come up and we do a requisition form every time we go to our raw materials warehouse or our raw materials storeroom, and we basically are buying here from our own stock. All right, we are making 50 ellipticals, so we need 50 heart rate monitors, 50 LCD screens, 100 roller bases, and we add up our costs. That way, on our raw material form, we know exactly what we are going into each one of these jobs. So we have the amount, we have the cost, and then we have our totals by taking our quantity times our unit cost. So here on our raw material record, we saw this before. So if you remember, we had on 11/30, we had our running total of 30. So again, because our production schedule was set up, we knew we had to order more. So our next line down, we ordered 75 more. So then we had a balance of 105. And that way, when we started our manufacturing on December 2nd, we had 50 in stock or more than 50 in stock. So we can take those out move them into our production facility where we start making and start putting together our elliptical machines, but we still have our running total. So again, received, we're adding. That used is when we're actually using that raw material into our manufacturing. And on the right-hand column is that running total. So we can see here, now on our job cost record, we'd go through, and for every requisition for this job 603, we're going to add that total cost for that requisition. So we needed some materials to get started. We put that together. We need some more materials. We have another requisition form. We need some more materials. We have another requisition form. Lastly, we have requisition 7601, where we have kind of our finishing materials. We add that all up. So you just go through on your job costing sheet, and if you think about when you're making something, you need some materials to get started, put that together or do that process. Then you go to another process, put some more stuff together, another process to put some other stuff together, until you have that finished product. So you might have multiple steps. So depending on the manufacturing process, you're probably going to get different materials added at different times. But in the business world and for the accounting purposes, we would have a requisition for each one of those. That way we can keep track of all the costs for this particular job. So we have here, for our job 603, we have $40,000 in our total job cost for direct materials. But we're not done yet, because we have to also add the labor and the manufacturing overhead. And likely in real life, these would be added all at the same time, right? Because someone had to take that materials from requisition 7568 and go grab it, put it together, and then get more materials. But this is just showing a step-by-step basis, first starting with direct materials. But that leads us to our direct labor cost. So remember, our direct material and direct labor is all that stuff that can be easily traced. And the way we do that is by saying we're using these significant components for direct material, we're using it on this job, so we're adding it to the cost of that job. For direct labor, we do it in the exact same way. And so people would do this by, on their time record sheets, they punch in, punch out for a manufacturer or for a company that's using job costing. For the direct labor employees, they're going to go ahead and when they put in their time in the system, they're also going to indicate what jobs they were working for. So in here, we have the labor time record for Hannah Smith. We have what jobs she was working on, the amount of hours, and her cost. And we get that cost by her 3 hours times, if you look at the top left there, her hourly wage of $20. 5 hours times 20, and then 8 hours times 20. But here, when we're talking about a job costing situation, the company, the employees, the ones that are actually making our product or providing our services, on top of saying when they started the day, when they ended the day, they're also going to indicate what job or what customer they're working for. And that way, on our direct labor portion of our job cost record, we can have, here's the amount of hours that they were worked on, and then we would have just a bunch of these time cards, depending on if it was one employee or a bunch of employees. You basically just go through, tally up however many hours they were working, times their hourly wage, and you go through, and now you have your total amount of labor that was worked to get to this job to be completed. So direct material, direct labor, pretty straightforward. The employees that are directly working on it keep track of their hours times their wage rate. That's their direct labor. Direct material, what material was used in the product, add all those up to get to that direct material. Where it gets a little bit more complicated is that final item, the manufacturing overhead. And if you can remember from chapters 2 and chapter 6, what is our definition of manufacturing overhead? And that's really all those indirect costs, those indirect manufacturing costs that come up that we want to make sure we can go through and capture, and then if we're doing job costing, allocate it to our jobs. And when I say allocating, it's basically taking our number, our total, and just splitting it up, dividing total manufacturing overhead costs among the jobs produced during the year. And what we want to do is, rather than, because again, manufacturing overhead are indirect costs that support our manufacturing, they don't always come in steadily on a day-by-day situation, on a job-by-job situation, right? If we look at our example, depreciation, utilities, property taxes, insurance, equipment, salaries and for the janitors and for the supervisors. These are all costs that not every job might have these on that day incurred, right? The supervisor's salary is going to get paid every 2 weeks. He's not directly working on every individual job, but he might be overseeing training the direct labor people. The janitor might just come in at night or come in on the weekends or something like that. Property taxes, maybe we pay that once a year. Insurance, maybe we pay that once a year. So it's going to be hard to say, all right, we paid the insurance this year on January 31st, so therefore we're going to allocate that to the jobs for that day. That wouldn't make sense from a job costing point of view, from a true expense point of view. So what we do instead is we try to come up with an estimated total manufacturing for the year, and then we're just going to apply it, allocate it to our jobs based on our specific cost driver. So that's what we try to do. We try to guesstimate what our overhead will be for the entire year based off of the amount of revenue, the size of our business, etc. And then we try to systematically allocate it to each individual job. That way we're just basically dividing up the pie and throwing it on each one of our jobs in a fair manner. Because in reality, for the most part, the depreciation, the property taxes, the insurance, those aren't going to be affected by the size of the job or the timing of the year of the job. Those are just fixed costs that are there. They're going to happen regardless of whether we have one job or 10,000 jobs. They're all going to pretty much be the same. They're fixed. So rather than trying to say, all right, this light bulb related to this job and that heater related to that job, etc., we just kind of come up with a total cost pool and then split it up based off of a certain cost driver. So that's what we go into. And now there is a 4-step process when we're starting to talk about allocating or applying manufacturing overhead. So just before we get started going through these, just keep in mind, sometimes I'll refer to it as allocated, sometimes I will refer to it as applied. Those are interchangeable, they mean exactly the same thing. The other thing that I'll say sometimes and the publisher will have differently, estimated and budgeted. Again, those are exactly the same. All right, so there's a 4-step process. So step 1, we estimate the total manufacturing overhead cost for the coming year. So we sit down, generally when we're making our budget for the year, we're going to try to sit down and figure out, based off of the amount of sales, based off of our company, the company's layout, the company's current mix of costs, we try to figure out at the very beginning of the year what is going to be our estimated, what's our budgeted total manufacturing overhead. And it's important that it's total manufacturing overhead, because just be on the lookout for problems for your homework, for quizzes, for exams. They like to throw in, sometimes they give you total, other times they'll give you, here's your variable, here's your fixed. But make sure we get our total. We want all of our manufacturing overhead. So if we're thinking about this, step 1, we're starting to build a formula. So step 1 is coming up with the numerator of our formula, our total manufacturing overhead. And just keep in mind, if they give you the variable and the fixed, generally we're going to use our formula, total cost equals our variable rate times our cost driver, so V times X, plus our fixed. So we want to make sure we use that formula if they give us the individual components of variable and fixed. So that's your numerator, your total budgeted or estimated manufacturing overhead. Step 2 is going to be our denominator, and that's going to be our budgeted cost driver. So that every business is going to be different, but the cost driver is what happens that makes us incur manufacturing overhead. All right. So for problems, 90% of the time to 95% of the time, it's going to either be direct labor hours or machine hours. So write those two down. Those are going to be the two most common ones. All right. So we're looking for our budgeted or our estimated total machine hours for the year, or total direct labor hours for the year. So that's going to be spelled out for you somewhere. In the problems, they don't always come in and like smack you in the face and say, here's our cost driver. Sometimes they just talk about one of those items. So they give you the machine hours for the year. They give you the actual machine hours for the year. They give you the budgeted. That's an indicator. That's where you can safely assume that that must be my cost driver, because that's the only time, that's the only real close thing they're given to me. So even though they don't come out and say it, it can be assumed. The other thing, it's always, cost drivers are always going to be, for the 99% of the time, they're always going to be some sort of hours or some side of other action. Like sometimes it could be miles driven, but generally it's going to be direct labor hours or machine hours. So just be on the lookout. Sometimes I might throw in another one of a kind of a curveball to try to get you confused, but always be on the lookout. Cost driver, I'm looking for some sort of hour or some sort of recurring activity. Very, very rarely, I think in the 2 years I've been teaching, I've only seen one problem where they didn't talk about some sort of hours, direct labor or machine hours, or miles driven. So 99% of the time it's one of those three, with I'd say about 90% of the time it's direct labor or machine hours. So step 3 is we're going to calculate our predetermined overhead rate. All right. So we're going to take our numerator of our estimated manufacturing overhead divided by our estimated cost base, or our estimated cost driver. All right. And that's going to come up with our predetermined overhead rate. And basically that is $1 per cost driver now. All right. So step 1, figure out what my total manufacturing cost is. Step 2, divide it by our total cost driver, estimated cost driver. All right. And now we have our predetermined overhead rate, which is now an hourly or a dollar per hour rate, or a dollar per mile rate, if that's that odd, rare problem where they talk about miles driven as our cost driver. Now that we have our predetermined overhead rate, you want to basically forget about our budgeted numbers. All right. So if we already have our predetermined overhead rate, sometimes the problem already gives you that, or sometimes you have to calculate it. But once you have your predetermined overhead rate, do not use your budgeted numbers again. All we need that for is to calculate our POHR, our predetermined overhead rate. All right. So in big letters in your notes, if you're following along, once you have your POHR, whether you have to calculate it or it's given, we don't use budget numbers anymore. Okay. It's an easy way to get problems wrong, where you take your predetermined overhead rate and then you try to multiply it or divide it by budgeted numbers again. Once you go through step 3, calculate that overhead rate, forget budget. Next, we're going to go through and we're going to allocate manufacturing overhead to our jobs based off of our actual cost driver. So we have there, so we take our predetermined overhead rate that we calculated in 3, and now in the manufacturing process, as we actually are incurring those cost drivers, we're going to just allocate it to jobs based off of that overhead rate. So we can see here, back to our job cost record, it doesn't show us, but it tells us that at the bottom for that manufacturing overhead, that the predetermined overhead rate is, we're going to apply $16 for every direct labor hour. So 16 times the 500 direct labor hours give us our total of 8,000 hours, or $8,000, excuse me. So now we have our 3 components of manufacturing costs, 40,000 of direct materials, 10,000 of direct labor, 8,000 of manufacturing overhead. So we add those all together to get our total job cost, $58,000. And again, like I said, we can now figure out our cost per unit by dividing our total job cost by the 50 units. So in theory, each one of these cost us $1,160 to manufacture. From here, the company will then say, all right, so if it cost us our manufacturing costs of $1,160 per unit, throw in that we're going to have some marketing, some advertising, some selling. They add that in based off of their estimate, and then they would figure out, all right, if it cost us, let's say, $1,160 of manufacturing cost, plus let's just throw in another $300 for selling and distribution costs, we need to make sure that our selling price is above that, so that way we can actually make some money off of that. But this is our first step. Let's figure out what's our manufacturing costs. All right. So from here, let's take a second here and we have a quick check. So quick check number 1. So this is basically coming through and we want to figure out what would be the recorded job cost for this WR53. So all the information you need is given here. We have, again, we need to add up all of our manufacturing costs, which is, again, our direct material, our direct labor, and our manufacturing overhead. All right, so take a minute. Let's pause the video here. I'm assuming you're pausing it now. And let's go ahead and try to solve this. So take a few minutes, and then when you're ready, unpause the video, and then we'll go over the answer. All right, so go ahead, take a shot at it. If you get it right or wrong, if you get it right, fantastic. If you get it wrong, don't worry, we'll explain it here. That way when you see this problem or a similar problem later on in your homework or on the quiz, you'll know what to do. Okay, so pause, and then we'll be back. Okay, here, so now that you've unpaused the video, we can see our solution. Okay, so when they're asking you for the job cost, you want to write down our three components. So our direct material, our direct labor, our manufacturing overhead. And then we go through based off of what the problem is given and take the information that we have and try to solve for those three. So pretty straightforward. It tells us our direct material is $200. It then tells us that we worked 10 direct labor hours at a rate of $15 per hour. So that's our direct labor cost, 15 times 10. Where most of the time these problems get a little tricky is when you have to start allocating your manufacturing overhead. So your first thing you want to look for is, do we have our predetermined overhead rate? In this case, we don't. However, in basically the second half of the information there, we can see that our estimated total overhead for the year was $760,000, and our estimated direct labor hours was 20,000. So again, it didn't tell us that this was our cost driver, but based off the information, that's the only place where we're talking about estimated numbers. So we can assume, safely assume, that that is our cost driver. All right. So for the most part, again, 99% of the time, they're not going to try to make you figure it out. They're just going to be talking about one of the more common ones. So they might have told you direct machine hours or direct labor hours. In this case, it's our direct labor hours. And again, we're looking for estimated numbers. All right. So we take our 760 divided by our 20,000 hours. We get 38. So now our predetermined overhead rate is $38 per actual labor hours. So again, we're going to take 38 times 10 is our 380, and then just add those three up to get to our 730. All right, moving along. So next, we're just going to talk quickly about determining the cost of a job and why that's important for making business decisions. So again, as we talked about on the kickoff of this chapter, for the most part, the way a company is going to become more profitable is to understand their costs. How much does it cost us to provide the products and services to our customers? So generally, for the most part, revenues, they're going to be pretty set. We have some flexibility, but if we suddenly want to grow our profitability 100%, 200%, 50%, whatever, we can't just simply go out and say, we're going to charge more for our products. Customers, for the most part, will accept a small price increase over time as they grow and grow. They might, if you increase it $1, over a couple years, we can increase our prices. But for the most part, a customer is not going to accept a 50% increase to the cost of their product or the cost of their service. So instead, for the most part, what businesses need to do is really understand and manage their costs, which from an employee standpoint can be very frustrating. But they're just trying to become more and more profit. They're trying to grow that bottom line. All right, because in theory, if we keep our costs the same but increase our revenues, we increase our bottom line. But if we can't change our revenues, a business has to reduce the costs in order to increase the bottom line. So that's the reason why we spend so much time, and here's a bunch of different examples on why we're spending so much time and resources on truly understanding our costs. The other thing to keep in mind, especially for job costing, all we're talking about is manufacturing costs. So that's why I said on our example for the elliptical machine where it had a manufacturing cost of $1,160, a business also has to keep in mind those non-manufacturing costs, the R&D, design, production, marketing, distribution, customer service, when they're coming up with their price, right? Because the manufacturing costs aren't the only cost associated with selling that product. So when they're coming up with their price, we have to factor that in as well. So for job costing, we never assign that to our job or to our customers for external purposes. So when we're producing our financial statement or our tax returns, we do not. Internal decision making, though, we want to have an idea of how much this non-manufacturing cost us on a job by job or customer by customer basis. Job costing excludes that completely. Next chapter, when we get to activity-based costing, we're going to pull some of those into our job cost to get a better, even better idea than just a traditional job costing system. But with that in mind, when we're thinking about pricing, we want to make sure we take into account not only our job cost, but also those non-manufacturing costs as well. So next we're going to go through, and again, a lot of the problems related to this chapter, especially what you'll be tested on, relates to what do we do when we get to the end of the year and we've been applying our manufacturing overhead based off of our predetermined overhead rate, which was based on budgeted numbers. What do we do at the end of the year when we get to the end and we have our total applied, but then we also have our actual overhead costs? What do we do with those differences? So here we have that under-allocated or over-allocated. Again, like I said, I sometimes refer to it as under or over applied. The old publisher I used referred to it as that. Applied, allocated means the same thing. So our manufacturing overhead, we're going to allocate it using our predetermined overhead rate, which is an estimate. At the end of the period, we basically go through and we want to compare our manufacturing overhead that is now known. All right. So again, our predetermined overhead rate, in our example for the quick check, it was $38 per direct labor hour. We're just going to go through and for every direct labor hour, we're adding $38 to that job or that customer. However, at the same time, when we actually get the bill for the supervisor's salary, for the rent, for the depreciation, for the insurance, we're going to keep track of that too, because we actually have to pay cash out for that. At the end of the accounting cycle, at the end of the accounting period, we go through and compare how much do we actually spend versus how much do we actually allocate. And we go and we figure out where we under allocated, which was when our actual manufacturing overhead is greater than what we've allocated, or are we over allocated, where our actual manufacturing overhead is less than our actual or our allocated manufacturing overhead. And I'm going to go through here before we go any further. When you're figuring this out, and again, I'm using applied here. I probably should have written allocated, but again, applied, allocated, same difference. When you're trying to calculate that, rather than trying to remember what way is which, if you just set it up in a very simple formula, you won't have to think too much about which way is this going, what does this actually mean. All right, so when we're calculating our under/over applied manufacturing overhead, what you want to do is you want to take your applied manufacturing overhead, which I got the two little stars there when we see below. Applied equals our predetermined overhead rate times our actual cost driver. So we take our applied, subtract it from our actual manufacturing overhead. So always set it up applied or applied minus actual. And that way, all you need to remember is if my answer is positive, I am over applied. If my answer is negative, I am under applied. All right. And for the most part in your problems, they're just going to say really where the crux of these problems are is figuring out that predetermined overhead rate and how to apply it. So the first half of our formula. For the most part on our problems, the actual manufacturing overhead will be provided. So it'll say here's our estimated numbers, and then it'll say the company actually incurred manufacturing overhead of $1 million and actually had direct labor hours of 25,000 or something like that. So the actual manufacturing overhead is generally pretty given, is pretty straightforward. Most of the time it's getting to the applied is where the problem is. But if you always set it up, applied minus actual, positive over applied, negative under applied. All right. So here, understanding our cost of goods sold for under allocated or over allocated, under applied, over applied. If jobs have been under costed due to the fact that our manufacturing overhead allocation was too low, that means that we haven't been putting enough costs through our inventory system, and the items that we sold in our inventory system were costed too low. So what happens when we fix that, because we don't want to leave it at the end of the day, we don't want to leave it as an under or over allocated, we want to always balance those out at the end of the year, at the end of the accounting cycle. If we were under applied To fix that, we have to increase cost of goods sold for the amount of the under allocation. So if we get to the point and our answer is that we are underapplied by 50,000 or 60,000 or 70,000, we have to go through and increase cost of goods sold and decrease manufacturing overhead. If our jobs have been overcosted, so we've been putting too much money, so our predetermined overhead rate was too high, we want to go back in time, and I like to think of this as kind of ripping the Band-Aid off, because you're not going to go through and change every individual transaction. At the end, we just kind of fix by taking care of this by figuring out, right, now we're overapplied by $50, $60, $70,000, whatever it may be. Now we're going to decrease cost of goods sold and increase manufacturing overhead. All right. The other thing to think about, and just as you're writing down, if you're taking notes following along, if you come up with your schedule and you come up with your T account for manufacturing overhead, on the debit side of our T account, that's always going to be our actual manufacturing overhead. On the right side is always going to be our applied manufacturing overhead. So if you don't want to use the formula, the other way of looking at this is just saying, before I make my entry for over or under allocated, which side of my T account is larger? If the actual is higher, that means we are under allocated. If the applied is higher, that means we are over allocated, over applied. All right. And then all we need to do is whichever side is higher. So if our actual, the debits had a balance of $100 and the credits only had a balance of 75, when we make our journal entry, we would just want to add another 25 to our credit. So that way our debits and our credits balance in our manufacturing overhead. And our offset is always cost of goods sold. So if we're crediting manufacturing overhead, we're debiting cost of goods sold. If we are debiting manufacturing overhead, we are crediting cost of goods sold. So it's always that journal entry: debit manufacturing overhead, credit cost of goods sold, or credit manufacturing overhead, debit cost of goods sold. It's always that same journal entry. It's just, are we over applied or are we under applied? Okay, so under applied, we increase cost of goods sold, therefore debit it. Over applied, we decrease cost of goods sold, therefore we credit cost of goods sold. So, and the offset is always manufacturing overhead. All right. So here we have another quick check, and it's quick check number 5, even though it's really only quick check number 2. We haven't skipped 3 quick checks. But we're just trying to figure out, are we over applied or are we under applied for Tiger Inc.? So take a minute, again, pause the video, try to go ahead and solve this problem. All right, so welcome back, and hopefully you took a minute or two and gave this problem a shot. If you were completely lost, don't worry, we're still just in the learning phase here. If you get it right, fantastic. All right, so our answer is that we are 50,000 under applied, and we can see here, first of all, we have to figure out what was our applied. How much of the overhead have we applied? So we take our predetermined overhead rate times our actual machine hours. So $4 times our 290,000. And in this particular case, they straight up gave us what our predetermined overhead rate was, and they also gave us what our actual machine hours were. So this would be, if I'm talking about an easy, medium, or hard problem, this would be an easy where they just spell it out for you. Here's the overhead rate. Here's our actual hours. Here is therefore our applied manufacturing overhead. All right. So next we take it into our formula, applied minus actual. So our 1,160,000 that we just calculated minus our 1,210,000 that was told in the first sentence was our actual manufacturing overhead. Our answer comes out to a negative $50,000. Therefore, we know if we're negative, applied minus actual, that means we are under applied. Okay? So the thing to keep in mind, though, is when we start talking about our over or under applied and we start making our journal entries, there's actually no negative numbers. Okay, so our answer would always be positive as far as the over or under applied, and as far as our journal entries, we don't have anything negative ever in our journal entries. The negative is just for our applied minus actual. All right, once you figure out it's an under applied, you don't need the negative sign. All right, just keep that in mind as you go through. We don't have negatives in our accounting system. All right, so learning objective 6 goes through the journal entries. And here, I don't want to spend too much time on it. You can go through these. just the thing to keep in mind as you go through their homework or on your quiz or on the exam when you're talking about your cheat sheet and getting that ready is these journal entries are going to pretty much always be the same, just with slightly different numbers. But what I want to focus on here is just that flow of information. And we can see here our factory, our work in process, this is the same diagram we saw earlier in the chapter. But in that work in process, not only are we adding our raw materials, we're also adding in our direct labor and our applied or our allocated manufacturing overhead. So that's all getting built up into that work in process inventory as we're actually preparing and doing our manufacturing. All right, so I'm just going to kind of fly through these journal entries. Again, this is in your chapter PowerPoint, so if you need them, just go refer to that. But they're pretty straightforward. They're all pretty much the same. If you were doing these or having to recreate them, you just want to follow, or here's if it's asking about purchasing raw materials, if it's asking about using direct materials, indirect materials, direct labor, indirect labor, other manufacturing costs. Here's one of the ones I want to make sure we focus on is how we allocate. So when we're actually allocating manufacturing overhead to our jobs, again, we're taking our predetermined manufacturing overhead rate, POHR is how I like to write it out a lot of the times on homework or on answers, and we're multiplying it by our actual hours used on those jobs. So 16 times 500 for job 603, and then 16 times 1,000 for job 604. All right, so we have our work in process inventory, our manufacturing overhead is based off of how we allocate the jobs. Lastly, again, our closing out of manufacturing overhead. So this is what I was talking about a few slides before. Once we figure out what our actual versus what our allocated is, and again, you can see on the left-hand side, our actual, that's when we're actually incurring these costs. We're actually paying the bills to our vendors or to our suppliers or to our employees. Actual goes on the left. Right hand is our allocated, so just the predetermined overhead rate times the hours used, our actual cost driver, if you will. And then we just get to the bottom of our T account and we get a subtotal. So we have on the left-hand side, our actual totaled 2 plus 13 plus 10,000, 25,000. Our allocated was only 24,000. So we right now have an unadjusted balance of 1,000 actual, 1,000 debits, basically. 25 minus 24. What you want to do when we're closing up manufacturing overhead is you just want to make a journal entry to get so that your debits equal your credits. So here, we're going to need a credit for manufacturing overhead, $1,000, which if we add that here, would now make it so our manufacturing overhead has $25,000 in the debits and now $25,000 in credits. All right, so that's all we're doing visually is we're making this account be a zero balance. Debit minus credits equals 0. So we'll have a subtotal based off of what's been allocated versus what actually has been incurred. We just see which side is bigger, and then we're just going to add a offsetting amount to the other side, so that way we balance out to 0. And again, our journal entry always is closed out to costs of goods sold. So again, we talked about this for a little bit, and just before we go, so in this case, our actual is greater than our allocated, so we were underapplied. If it was the other way around, where our credits were higher than our debits, our journal entry would just be flipped. So we would debit manufacturing overhead, credit cost of goods sold. So it's always those two accounts, and it's just a matter of, is it debits for the cost of goods sold or is it credit for cost of goods sold? And if it's debit for cost of goods sold, it has to be credit for manufacturing overhead. And if it's a credit for cost of goods sold, it's got to be a debit, because those are the only two accounts, and our entry's got to balance. And again, don't put negatives. So lastly, here we have our total cost and profit markup, and this is what we were talking about a little bit before. We want to figure out our total job cost of servicing our clients or providing that manufacturing, that product to our clients. We want to make sure we get all of our total direct costs that can be traced, so our direct material, direct labor, and manufacturing overhead. Plus, we want to make sure we get those indirect costs that we allocate to clients, and that can also include those non-manufacturing costs if we can get an estimate for that. That's our total job cost, and then we're going to add our markup to figure out how much we should bill our client. So how much of our resources was used, and then basically how much profit do we want to make off of this individual job, individual client. All right, so it's total cost plus markup basically is what that is called. So that's the end of chapter 3. So I appreciate you guys listening and following along. If you have any questions, as always, feel free to reach out, email me, send a message in actually just email me. It's the easiest way. If you want to come by and see me for office hours, I'm available pretty much all week. Just again, shoot me an email, and we'll see you next week for chapter 4. My courses, you'll see what is on the docket for this week. You have your normal quiz and homework assignment on on Pearson, My Accounting Lab, excuse me. We have a discussion board, and then also I have a little bit of extra credit if you want it for your first exam, if you didn't do as well as you wanted. So check out all the happenings for this week for chapter 3, and then we'll see you back next week for chapter 4. All right, so have a good week, and we'll see you then. Bye.